The Fed just pulled a move that could silently shrink every pound, dollar, and euro in your bank account, and nobody's talking about it. Stay with me, because if you've got a savings account, this is literally about your lifestyle next year. Hi, I'm Felix. Welcome back. Today, we unpack the Fed's 2025 playbook, rate cuts, balance sheet shrinkage, and a policy shift that together can eat your savings through inflation and market moves. I'll show you 3 specific threats and 6 practical moves to protect your money, so watch till the end. Why this matters. 1. On September 17, 2025, the Fed cut rates. That changes what banks pay you and how the markets behave. 2. Behind the scenes, the Fed is still running down, shrinking, its big balance sheet that reduces liquidity and can push yields and borrowing costs around in weird ways. 3. Inflation is still stubbornly above target, meaning prices can keep rising even as headline rates fall, which eats your real savings. The 3 ways the Fed hurts savers. 1. Lower interest on cash. When the Fed cuts, banks lower rates on savings accounts and CDs. Your safe money stops earning real returns. 2. Inflation outpacing returns. Even if your interest rate is unchanged, inflation at approximately 3% or more means your purchasing power falls. 3. Market spillovers, risk assets, and AMP hidden fees. Lower Fed rates can push investors into riskier assets, creating bubbles that eventually burst. Pension and fund values wobble and banks alter fees and lending terms. The secret play. Okay, the secret isn't literal conspiracy. It's policy stacking. Rate cuts plus balance sheet adjustments plus subtle messaging. Each alone is manageable. Together, they change how liquidity flows through the system and how much your safe cash actually buys next year. 6 actionable moves to protect your savings. 1. Shift a portion to short-term tips or inflation-protected products. 2. Ladder high-yield CDs only when the rate is attractive. 3. Keep an emergency stash in accounts that still beat inflation or tied to short-term market yields. 4. Diversify into hard assets, gold, silver, or inflation-resistant real assets. 5. Use cash alternatives, short-duration bond funds, floating-rate notes, or money market funds. 6. Trim household spending and build a rolling 6-12-month real value emergency fund. What the Fed says in plain English. They say their dual mandate and new strategy aim for stable prices and employment. But the transition period is messy, and policy tools affect savers differently than investors. If you found this useful, hit like, subscribe. Share this with anyone who keeps their life savings in a low-interest account. They need to hear this. This is Felix. Stay sharp, protect what's yours. I'll see you next time.